This is part 4 of the Chapter 4 lecture series on the last 4 steps of the accounting cycle. Let's get started. In the last 2 videos, we discussed the 5th step of the accounting cycle, which is journalizing and posting adjusting entries. In this video, we are going to complete our discussion of the accounting cycle, beginning with a discussion of the 6th step of the accounting cycle, which is preparing an adjusted trial balance. The adjusted trial balance has the same format as the original trial balance, but now all of the balances are correct. We use the adjusted trial balance to prepare the financial statements. Here is the adjusted trial balance for Sierra Corporation. It looks very similar to the original trial balance, but now the balances are correct. The corrected balances are in red. For example, remember that Sierra had $1,000 worth of supplies on hand at the end of the month? Before adjusting entries, supplies had a balance of $2,500, which was overstated. Now supplies has the correct balance of $1,000. Now let's talk about the next step of the accounting cycle, which is preparing financial statements. We are finally ready to prepare financial statements. We simply use the numbers from the adjusted trial balance to create the financial statements, starting with the income statement, then the retained earnings statement, and then the balance sheet. Let's look at the financial statements for Sierra Corporation. These are the financial statements for Sierra Corporation for the month of October. Hopefully they look familiar to you because we looked at these financial statements in Chapter 1. We start with the income statement. We pull the income statement items from the adjusted trial balance. We then prepare the retained earnings statement, pulling the beginning retained earnings number from the adjusted trial balance, the net income number from the income statement, and the dividends number from the adjusted trial balance. Finally, we prepare the balance sheet, pulling the asset, liability, and common stock numbers from the adjusted trial balance, and the retained earnings number from the retained earnings statement. As you can see, once we prepare the adjusted trial balance, the financial statement preparation is fairly easy. After we prepare financial statements, we are ready to close the books by preparing and posting closing entries, which is the 8th step of the accounting cycle. In closing the books, we zero out certain account balances to get the books ready for the next period. There are 3 important terms related to closing that you must learn. First, you must learn what accounts are temporary. Temporary accounts are the accounts that impact retained earnings. You should remember from the expanded accounting equation that these accounts are revenues, expenses, and dividends. The transactions in these accounts affect only one period, so they are considered temporary and must be closed at the end of the period. Remember from Chapter 1 the time period for the income statement and the retained earnings statement. We report only those revenues, expenses, and dividends for the period covered. For example, if our period is for the month ended October 31st, 2013, that means we want to report the revenues earned, expenses incurred, and dividends declared during the month of October, not before and not after. If we didn't close these accounts, we would report the entire amount of revenues, expenses, and dividends since the company began business. This is the reason why we close the books, to zero out the balances in our revenue, expense, and dividend accounts so that they will report only the revenues, expenses, and dividends for the current period and not before. The balances in our permanent accounts, on the other hand, are not zeroed out. They are carried forward to the next period as the beginning balances for that period. Our permanent accounts are assets, liabilities, and stockholders' equity items. The last term that we must learn is income summary. This account is used to close out revenue and expense accounts. It is used during the closing process and is zeroed out during the closing process. It is never seen on any financial statement. Now let's learn our closing entries. There are 4 closing entries that we must learn. The first closing entry involves closing out revenue accounts to income summary. A revenue account has a normal credit balance, so we must debit it to zero it out. As an example, if we had service revenue and rent revenue, we would debit these accounts to zero them out and credit income summary for the total. The second closing entry involves closing out expense accounts to income summary. An expense account has a normal debit balance, so we must credit it to zero it out. As an example, if we had rent expense, depreciation expense, insurance expense, and salaries and wages expense, we would credit these accounts to zero them out and debit income summary for the total. The third entry involves closing out income summary to retained earnings. After the first two closing entries, the balance and income summary will be the net income or net loss for the period. If the company has a net income, you would debit income summary and credit retained earnings for the balance and income summary. If the company has a net loss, you should debit retained earnings and credit income summary for the balance and income summary. The last journal entry involves closing out dividends to retained earnings. The normal balance of the dividends account is a debit balance, so we must credit it to zero it out, so you should debit retained earnings and credit dividends for the amount of the dividends for the period. Through the closing process, we essentially close all revenues, expenses, and dividends to retained earnings, so the beginning balance of retained earnings for the next period will reflect these revenues, expenses, and dividends. It's important to remember that retained earnings is not a temporary account. It's a stockholders' equity account and therefore is permanent. Revenues, expenses, and dividends get closed to retained earnings, but we do not close retained earnings. Let's look at the closing entries for Sierra Corporation. Sierra only had one revenue account. We close it to income summary in the first entry by debiting service revenue and crediting income summary. We then close all expense accounts to income summary by debiting income summary for the total expenses and crediting the individual expense accounts. We then debit income summary and credit retained earnings for the balance and income summary, which is the net income for the period. Lastly, we debit retained earnings and credit dividends for the amount of dividends for the period. Once we prepare and post closing entries, we are ready to prepare the post-closing trial balance, which is the ninth and final step of the accounting cycle. The post-closing trial balance has the same format as the original and adjusted trial balance, except now the only accounts listed are the permanent accounts, which are assets, liabilities, and stockholders' equity accounts, because the temporary accounts have zero balances and are therefore not listed. These are the balances that will be carried forward as beginning balances for the next period. We have officially completed the accounting cycle. We identified events that needed to be recorded. We journalized these transactions in the general journal. We posted them to the ledger. We prepared a trial balance. We then journalized and posted adjusting entries. We then prepared an adjusted trial balance, which we used to prepare financial statements. We then journalized and posted closing entries. And then lastly, we prepared a post-closing trial balance. Again, we go through this accounting cycle every period. We have also learned three types of journal entries. We have learned general journal entries, which are used to record accounting transactions. We also learned adjusting journal entries, which are used to correct balances and to ensure that the revenue and expense recognition principles are followed. And lastly, we learned closing journal entries, which are used to close temporary accounts after financial statements are prepared. This completes part 4 of the Chapter 4 lecture series on the last 4 steps of the accounting cycle. I hope you have a great day.